Hey, what's up everyone? Welcome back to the channel. If you're new here, make sure to hit that subscribe button and ring the notification bell so you don't miss out on any of our future content. Today, we're diving into one of the most popular and profitable markets to trade, the Dow Jones Industrial Average, also known simply as the Dow. Whether you're brand new to trading or already have some experience, I'm going to break down how you can make money trading the Dow step by step. I'll be covering day trading, swing trading, long-term investing, and some advanced strategies, so make sure to stick around until the end for some bonus tips that could really boost your profits. Let's dive in. First off, what exactly is the Dow Jones? The Dow Jones Industrial Average, DJIA, is one of the oldest and most well-known stock market indexes in the world. It tracks the stock performance of 30 of the largest and most influential companies in the U.S., ranging across industries like technology, healthcare, consumer goods, and finance. Some of the big names in the Dow include Apple, Microsoft, Boeing, Coca-Cola, and Goldman Sachs. These are not just any companies. They are industry leaders and key players in the U.S. economy. So, when you trade the Dow, you're essentially trading a slice of the American economy. That's why it's such a popular index for traders and investors alike. The Dow is a benchmark for how the stock market, and often the broader economy, is performing. Now let's talk about how you can actually trade the Dow Jones. There are several ways to get exposure to the Dow, and choosing the right method depends on your risk tolerance, time horizon, and trading experience. The first and easiest method is through ETFs, exchange-traded funds. The most popular ETF that tracks the Dow is DIA, sometimes referred to as the SPDR, Dow Jones Industrial Average ETF Trust. This is an easy way for anyone to get exposure to the entire index with just one trade. It's essentially like buying a basket that includes all 30 Dow companies. This is great for beginners who don't want to pick individual stocks, but still want to benefit from the Dow's overall performance. Another option is trading Dow Jones futures. Futures are contracts that allow you to speculate on where the Dow will be at a specific point in the future. These contracts trade on platforms like CME and are often used by more advanced traders due to their leverage and complexity. Futures allow you to control a large position with a smaller amount of capital, which can amplify both profits and losses. This makes them more suitable for experienced traders who understand how to manage the risks involved. Finally, you can also trade individual stocks that make up the Dow. For example, if you think Apple or Johnson & Johnson is set to outperform the rest of the index, you can just trade that particular stock. This is a more targeted approach and requires you to do some research into the specific companies you're trading. So, how do you actually make money trading the Dow Jones? Well, there are multiple strategies depending on your style of trading, and I'll break down the most popular ones for you. First up is day trading. Day trading is all about making short-term trades to capitalize on small price movements within a single trading day. This strategy works best if you're able to actively monitor the markets and make quick decisions. Today, trade the Dow successfully, you'll need to use technical indicators like moving averages, RSI, Relative Strength Index, and Bollinger Bands. These tools help you spot trends and reversals in the market, allowing you to time your trades more effectively. Another key tip for day trading is to pay attention to news events. The Dow is heavily influenced by economic data, company earnings reports, and broader news, like changes in interest rates or the release of the monthly jobs report. These events can cause sharp movements in the index, creating opportunities for profit. For example, if the Federal Reserve announces a rate hike, the Dow might drop sharply, providing a great shorting opportunity. On the other hand, if a company like Apple releases stellar earnings, the Dow could spike, and you could ride that momentum. The goal is to capitalize on these short-term price movements and exit your positions before the day ends. Not into staring at the charts all day? No problem. Let's talk about swing trading. Swing trading involves holding your positions for a few days or even weeks, and it's a strategy designed to capture larger price moves. This approach gives you more time to analyze trends and doesn't require the minute-to-minute monitoring that day trading does. To get started with swing trading, you'll want to use longer-term indicators like the 50-day moving average or the 200-day moving average. These help you identify whether the market is in an uptrend or a downtrend. Once you've spotted the trend, you can set your entry points during pullbacks, a temporary drop in price within a larger upward trend. Your goal is to buy low and sell high, riding the price movement for as long as the trend lasts. It's also important to set your stop-loss orders just below key support levels, which will protect you from major losses if the market turns against you. Swing traders can also use MACD, Moving Average Convergence Divergence, to identify momentum shifts in the market. When the MACD line crosses above the signal line, it's typically a buy signal. When it crosses below, it's a sell signal. Swing trading the Dow allows you to capitalize on both bullish and bearish trends without the high pressure of intraday trading. If you're in it for the long haul, consider long-term investing in the Dow Jones. The buy and hold strategy is simple but effective, especially for beginners or those who don't want to constantly monitor the markets. Long-term investors benefit from the overall growth of the economy and the Dow's historical average return of 7 to 8% per year. Over time, even small regular investments can grow significantly thanks to compound interest. A popular approach for long-term investors is dollar cost averaging. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, say monthly or quarterly, regardless of the market's performance. This strategy helps reduce the impact of volatility, as you'll be buying more shares when prices are low and fewer when prices are high. Over time, this can lower your average cost per share and increase your profits. When investing for the long term, ETFs like DIA are a great option, as they provide diversified exposure to the Dow without the need to manage individual stocks. And since the Dow's companies are typically large, well-established firms, they tend to provide more stability compared to smaller, riskier stocks. But no matter what strategy you use, managing your risk is crucial if you want to make money trading the Dow. One of the most important rules in trading is to always use a risk-reward ratio. Ideally, you want to aim for at least a 1-to-2 ratio. This means that for every dollar you risk, you're aiming to make $2. By maintaining this ratio, even if only half of your trades are successful, you can still be profitable. Another essential tool is the stop-loss order. Always set a stop-loss on your trades to minimize your potential losses. A stop-loss automatically sells your position when the price drops to a certain level, protecting you from more significant losses. For example, if you buy the DIA ETF at $350, you might set a stop-loss at $340. This way, if the trade goes against you, you only lose a small portion of your capital. Finally, it's important to diversify your trades. Don't put all your money into one stock or even one sector. Spread out your investments across different sectors or even different asset classes to reduce your overall risk. For instance, if tech stocks in the Dow are having a rough week, other sectors like healthcare or financials might perform better, balancing out your portfolio. One last thing to keep in mind is understanding the broader market conditions. We all know that markets go through cycles. Sometimes we're in a bull market where prices are rising, and other times we're in a bear market where prices are falling. In a bull market, most traders focus on buying stocks or ETFs and riding the upward trend. But in a bear market, making money requires a different approach. This is where strategies like short selling or using inverse ETFs come in handy. Short selling allows you to profit from falling prices by borrowing shares, selling them at the current price, and then buying them back later at a lower price. Another option is to use inverse ETFs, like DOG, which increase in value as the Dow declines. These strategies allow you to profit even when the market is falling, but they come with higher risks. So make sure you understand how they work before diving in. For those of you who are more experienced, let's quickly talk about Dow futures trading. Futures contracts let you trade with leverage, meaning you can control a larger position with less capital. This can significantly increase your profits but also your losses, so it's not for the faint of heart. Dow futures are traded on the CME, Chicago Mercantile Exchange, and give traders access to 24-hour markets, making them great for those who want to trade outside of regular stock market hours. If you choose to trade futures, make sure you're comfortable with the concept of margin, the amount of money you need to put down to control a larger position. Be sure to have a strong risk management plan in place and don't over-leverage your account. So that's the breakdown of how to make money trading the Dow Jones. Whether you're a day trader looking for short-term gains, a swing trader aiming to catch bigger moves, or a long-term investor building wealth over time, there's a strategy for you. The key is to stay disciplined, manage your risk, and keep learning. If you found this video helpful, hit that like button, subscribe for more trading tips, and let me know in the comments what strategy you're most excited to try. Thanks for watching, and I'll see you in the next video.